the Reserve Bank of India has approved the transfer of 2.69 lakh crores to the central government of the country. Now, this is 27% more than the last year's surplus transfer of the RBI to the government, which was just 2.11 lakh crores. Now, this amount is massive. 2.69 lakh crores of funds being transferred by RBI, the RBI's profit being transferred to the central government for the financial year of 2025-2026. The government's budgeted estimates were just 2.56 lakh crores from the central bank, from the public sector banks, and from the insurance firms combined. But alone Central Bank of the country gave the central government 2.69 lakh crores, which is much beyond the expectation of the central government. Now, this surplus has been approved based on the revised estimates of economic capital framework of the Reserve Bank of India, and also because the contingent risk buffer has been increased to 7.5%. Now, what is this transfer all about? Why RBI transfers surplus to the central government? And from where does RBI earn money? And what is this economic capital framework? What is this contingent risk buffer? All these questions we'll be trying to answer in this particular session. Hello, my name is Preetpal Singh and you're watching Perspective. Now let's talk about Reserve Bank of India first. RBI was formed on the basis of Reserve Bank of India Act of 1934. This act came into play on the recommendations of Hilton Young Committee, and this committee was formed by the then Viceroy of India, Lord Reading. Now, after the coming of RBI, Reserve Bank of India, which became the central bank of the country in 1935, initially RBI was owned by private shareholders. That is financial institutions, prominent financial institutions in UK, in Britain, and in India. Now, who was the actual owner, we do not know. But 1947 onwards, and after 1949 to be specific, RBI was nationalized. And then RBI became the central bank of the country, wholly, completely owned by the central government. So now, RBI is controlled by the central government of the country because it is the central bank of the country. Now, keeping this in mind, we all know that Reserve Bank of India is the banker to the banks. Now, RBI is the banker to the government and it is banker to the commercial banks as well. So there are three layers. For example, in first layer, there is the RBI. In the second layer, there are the commercial banks. And on the third layer, it is the public. So if public have to do any banking transactions, they go to the commercial banks. If commercial banks have to do any banking transactions, they go to the RBI. So RBI is the custodian, it's the guardian, and it is the lender of last resort of the banking system of our country. Which means RBI is actually the regulator of the entire banking system of the country. Now, as already discussed with you, recently RBI has transferred around 2.69 lakh crores of its surplus funds to the government. But before understanding that, we need to understand that why RBI is transferring funds to the government. See, I already told you that RBI is completely owned by the central government, but RBI is not a company. Let's say if RBI would have been a company, the money given by RBI to the central government would be called as a dividend. Now, for this, let me take an example. Let's say there is a State Bank of India. Now, State Bank of India is a public sector undertaking owned by the government of India. Now, SBI, whatever profits they earn in a one single year, financial year, the portion of that profit they give to the government based on government's ownership in the SBI. So, let's say the government is having 60% shares of State Bank of India. 60% of the shareholdings of the State Bank of India. Whatever profit State Bank of India earns, let's say State Bank of India earns 100 crores profit. Out of that 100 crore, 60% would be given to the central government at the end of the financial year because central government is the 60% owner of SBI. This percentage of profit being given to the shareholders is what we call as a dividend. But since RBI is not a company, RBI is the central bank of the country. The profits which RBI earns, after subtracting all the expenditures and everything, the actual profit which RBI earns, that profit, when RBI transfers to the government, it is not known as dividend, it is known as surplus transfer. So now it must be very clear in your mind that since RBI is owned by the government, whatever profit RBI earns, certain portion of that profit RBI keeps with themselves and rest of the portion RBI has to transfer to the government because who owns the RBI? It is the central government. And what will RBI do of that surplus money, which is in lakhs of crores? RBI has no use of it. RBI transfers it to the owner, which is the central government. This is why RBI transfers the money. That is first part. The second part of your question which you might ask is that how does RBI earn money? RBI is a regulator, it is a watchdog. But other than that, RBI performs many functions. Based on the functions performed by RBI, I'll be listing down 4 to 5 important functions. Based on those functions, RBI earns huge amount of money. That huge amount of money is RBI's profit after subtracting the expenditure, and that is the profit which RBI gives to the central government. Now let's take an example. The first thing which RBI does is RBI prints currency. Now RBI prints currency notes in the country. Now let's say to print a 500 rupee currency note, RBI incurs a cost of, let's say, 3 rupees. The 3 rupee cost incurred by the RBI to print that currency note of 500 rupees, when commercial banks buy that 500 rupee note from the RBI, they are buying it at 500 rupees, but RBI is printing it at 3 rupees. The 497 rupees profit of the RBI is what RBI earns. And this is what we call as seigniorage. So that is the first way through which Reserve Bank of India earns money. Now there is a second way as well. We all know that Reserve Bank of India does one operation, that is open market operation, OMOs, that is buying and selling of government securities. Now when the Central Bank of India buys or sells government securities, actually they hold foreign securities as well. So RBI of the central bank of our country buys foreign securities from the foreign governments, from the foreign central banks. And from those foreign securities, RBI earns a certain interest. And that interest earning of RBI is also a part of the revenue generated by RBI. Also, it is in a humongous amount. It is very huge. So that is the second source of income for RBI, that is interest earned through holding foreign securities. That is second. And if you remember, I told you that RBI is the banker to the government and RBI is the banker to the commercial banks, which means RBI would lend money to the commercial banks, would lend money to the governments as well, state government and the central government. The interest which RBI earns while lending to the central government, while lending to the state government, while lending to the other commercial banks, the interest which RBI earns from them is also the source of income for the RBI. That is the third source of income, the interest income of lending to the central government, state government and commercial banks. That forms the third source of income, and that is also humongous and that is very huge. Also the fourth and the final one, there are a lot of other avenues of RBI earning money, but the fourth most prominent one is when RBI buys and sells foreign currency. Now, for example, RBI buys US dollars when US dollar is at 60 rupees per dollar, $1. But when after 2 years, when dollar becomes 80 rupees per $1, RBI sells those dollars in the international market. So which means when dollar appreciates, RBI if sells the dollars in the international market, which very recently RBI sold as well, RBI earns humongous money. RBI earns profit. The appreciation amount is the RBI's profit because RBI holded the dollars with themselves. So by selling the dollars in the international market and due to appreciation of dollars or any other foreign currency, whether it be pounds, yen or any other currency, if a currency appreciates and RBI sells the currency after appreciation, RBI again earns money. And that is the fourth prominent source of RBI to earn revenue. But till now we have just been talking about RBI's revenue. RBI also does a lot of expenditure. RBI has to give certain interest rate in the form of liquidity adjustment facility, in the form of reverse repo rate, and also RBI has to spend money in printing of the currency, in staff operations, in operation of such a big institution as RBI. RBI has a lot of operational cost as well. So when the revenue which RBI earns from these four prominent sources and different other sources as well, when the revenue is subtracted by the costs and expenses incurred by the RBI, we get to know RBI's profit. And that RBI's profit is transferred to the central government. But there is one more provision hidden under this. To understand that provision, we have to understand about economic capital framework of RBI, ECF of RBI. Now let's take an example. For example, after deducting all the expenses, after having the revenue and deducting all the operational and every expense which RBI could incur, let's say RBI gets a profit of rupees 100. Now generally, central government would be tempted to get that entire 100 rupees from the RBI because 100 rupees, the more profit, the more surplus the central government gets, the better it is for the central government because central government needs a lot of funds to run the country for the development of the country. So more funds the central government gets, more happier they would be. But there is a single provision. That provision is of economic capital framework where RBI says that if we give you the entire 100 rupees, then in the case of risk, in the case of contingency, in the case of emergency, in the case of fluctuation, what will we do? We need to have certain money as a buffer. We need to have certain money as a security with us so that if any unforeseen circumstance comes in future, we are able to deal with that without taking help of the central government. which is why certain money we need to have with us in order to ensure that any unforeseen circumstance doesn't damage the reputation and doesn't damage the working of the Reserve Bank of India, which is why economic capital framework was introduced. Now, the recent economic capital framework which we see is introduced in 2019 and was suggested by one committee, Bimal Jalan committee, in 2018. Now, Bimal Jalan, as you would know, is the former governor of RBI and has been in numerous economic positions in the country and a very prominent economist for the country. Now, Bimal Jalan committee in 2018 suggested that central bank of the country should have an economic capital framework whereby they should have certain percentage of funds be kept as reserves, be kept as a buffer, which means a framework was developed where certain part of the profit needs to be kept as capital with the Reserve Bank of India to deal with any monetary, credit, operational and contingency risks. To deal with that, a framework was announced in 2019 on the basis of Bimal Jalan Committee's recommendation. That framework is what we call as Economic Capital Framework, ECF. Now the question is that how much percentage of the profit should be kept by the Reserve Bank of India as a buffer? That is the question. So the Bimal Jalan committee recommended. Now this 5.5 to 6.5% buffer which the central bank keeps with themselves is what we call as contingent risk buffer. So under the economic capital framework, which is there to ensure that any risk, unforeseen risk or unforeseen circumstance should be dealt by the RBI themselves, under that economic capital framework, one concept was introduced, and that concept is contingent risk buffer, CRB. And that contingent risk buffer in our country would be 5.5 to 6.5% of the total surplus, and that was what was recommended by the Bimal Jalan committee. And it was also recommended that this economic capital framework, it would be reviewed every 5 years. So after every 5 years, there would be an updation, there would be a review of this particular percentage. Now, let's take that example forward. Now, after deducting all the expenses, 100 rupees are left with RBI in the form of profits. Now, the central government would want the entire 100 rupees, but on the basis of economic capital framework, out of that 100 rupees, 5.5 to 6.5% needs to be kept by the RBI with themselves in the form of contingent risk buffer. So what is the contingent risk buffer? It can be around 5.5 crores to 6.5 crores in the example which we are seeing. And other than that, the other amount, for example, if the contingent risk buffer is 5.5 crores. Now, other than that, 94.5 crores, the leftover amount would be transferred to the central government as surplus transfer. And this is what has been done recently. But recently, there is one more change which we could see. To understand that change, we have to go back in 2024. Now in 2024-2025, because of the updation, because every 5 years, this economic capital framework would be updated. So this updation happened by the RBI board, and the RBI board updated the contingent risk buffer. Earlier it was 5.5 to 6.5% to be kept with RBI themselves. Now it would be around 4.5 to 7.5%. So the range has been broadened, the range has been widened. So RBI can keep with themselves anywhere between 4.5% of the surplus to 7.5% of the surplus, depending on the situation, depending on the condition, and depending on the economic scenario. And as I told you, in this particular year, there has been a change made. So earlier, we were using the 6.5% as contingent risk buffer. The last year, we used 6.5%, which means RBI kept with themselves 6.5% of the entire money. But this year, RBI kept with themselves 7.5% of the total surplus. So whatever the total surplus was, 7.5% of that surplus was kept by RBI with themselves in the form of contingent risk buffer. And other than that, how much is left? 92.5% is left. 92.5% is now given to the central government as record surplus. So this 2.69 lakh crores, which has been transferred by the RBI to the central government, it is 92.5% of the entire surplus of the RBI. And 7.5% of the surplus has to be kept by the RBI with themselves in the form of contingent risk buffer. I hope now the concepts are extremely clear in your mind. Also, technically speaking, is it written anywhere that RBI would give the money to the central government? The answer is yes. So under the section 47 of RBI Act of 1934, central bank has to mandatorily transfer its surplus funds to the central government. So under this section, it is mandated as well. And how this economic capital framework and how this contingent risk buffer aligns with this, we have already discussed. Now let us just discuss just one particular issue which many people have been pointing out. Many people have been pointing out that this record surplus transfer to the central government by the central bank, it might loosen or weaken the authority of the central bank, and it might make central bank a little bit more fragile. But there are always two sides to the coin. One side of the coin is that this surplus transfer is mandatory and this is an international norm. Internationally, most of the developed nations, the central bank gives the surplus transfer to the central government. So internationally, this is a norm definitely. And on the other hand, one positive is that it helps the central government to reduce its fiscal deficit. Otherwise, to finance the fiscal deficit, central government has to borrow from different sources, from external source, from internal source. But this surplus transfer by the RBI to the central bank, it comes as a good news for the government. Because through this transfer, government is able to manage its fiscal deficit in the prescribed limits. So this is again for the central government, it is very good. And for the central government, if it is good, now the central government has more avenues to spend for the development of the country and to spend for the public of the country. So for the public also, it is very good because eventually RBI's money is being used by the government and government is using this money for the public. So eventually who's getting the benefit of this surplus transfer? Eventually the public is getting the benefit of this surplus transfer. So in that way, it is positive. But one negative side to it, which is why there was a controversy in the year 2018 as well, where then Deputy Governor of RBI, Viral Acharya, and also the Governor of RBI, Urjit Patel, they were against it to an extent of transferring surplus money to the government. They were against this particular idea, and which is why they gave an example of Argentina as an economy. But yes, Argentina and India can't be compared because economic size and economic structures are very different for both the countries. But still, there was huge resistance to this economic capital framework and to this contingent risk buffer and also to this surplus transfer by the RBI to the government. And after that, in 2019, this Bimal Jalan Committee recommendations were adopted and this economic capital framework and contingent risk buffer framework came into the country. So it is not devoid of any controversy. There are a lot of controversies around this and there are a lot of second opinions also around this. One is positive, one is negative. And the negative part, they say that RBI transferring the surplus money to the government makes RBI more fragile, and sometimes if in future a huge risk comes in front of RBI won't be able to manage it because contingent risk buffer won't be enough. So one learning which we can get from here is that RBI should be definitely transferring some funds, some surplus funds to the central government, but should central government be solely relying on RBI for fueling its surplus funds or fueling its revenue or receipts? The answer is no. Which is why RBI's fund transfer is good, but the government solely relying on it to manage its fiscal deficit is wrong. Which is why government needs to find other avenues of revenue, receipts and other kind of capital and revenue receipts as well, which is why we need to ensure that the government takes prudent measures to reduce its fiscal deficit, to control its fiscal deficit, and also to maintain a fiscal safety net for the RBI as well. It shouldn't be that whatever profit RBI earns would be given to the government, and it shouldn't be that way, other way as well. That RBI, whatever money they earn, they should keep with themselves. It should be a balance between the fiscal need of the government and between the financial safety net of the RBI. If that balance is maintained, the overall macroeconomic stability of the country would be on point. I hope you got a new perspective from this session and all the concepts of this issue are clear in your mind. All the very best and have a beautiful day. Thank you.